The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to this webinar, Basics of Knockouts and Binary Options. Some unique products that Nadex offers designed specifically for retail traders. So my name is Todd Rich. I'm head of education over here. And before we get into this presentation, I do have to take care of some housekeeping items. The first of which is this disclaimer. I need to put this up here because our webinars are sponsored by our compliance department. And trading on Nadex does involve risk, and all of the trading decisions are solely your responsibility and done at your own risk. I'm leaving this slide up so you can read through it. But there is one really important takeaway from this, and that is nothing that I say today should be taken as a buy or sell recommendation. Don't construe anything I say as a buy or sell recommendation, but I will tell you we are going to jump in and look at some live markets and play around a little bit as I explain these products and show you how you can access these markets. And I certainly don't want you to take any of that as a buy or sell recommendation. I'm doing this for your education purposes only. All right, so what are we going to do today? We are going to talk about knockouts and binary options. I'm going to define them for you. We're going to jump over to the platform. I find that a lot of the times it is much easier to understand these products if I show you. So I'm going to do just that. And then we're going to go through some examples, and it'll become very tangible at that point what these products are, what the opportunities are, and how you can access these markets. It'll be fun. So buckle in. Now, I do want to point out that this is an interactive session. I've got my colleague Sophie in the background, and you have a little questions box. You can type questions as we go. If you're having any questions about Nadex generically, if you've got questions about your account or a demo account, and we're going to discuss that a little bit as well, or about any of the products. If I go too quickly or I say something that sounds a little confusing, please type a question into Sophie. In fact, it's not a bad idea just to type in anything to Sophie every once in a while just to keep her on her toes. She's a great resource. You've got access to her. And so please, if there's anything that you need additional clarity on, do not hesitate to interact with Sophie in the background. In the end, I will also try to go back and take a look at some of the questions and cover them if it sounds like it's something that I might have skimmed over a little too quickly. Often, if one person has a question, other people on this will have the same question, so I want to make sure that they get answered. So let's start, and I'm going to go through some quick definitions first. What are knockouts? What is a knockout? And a knockout is a contract, and it's a contract that trades within a set price range. We set a price range, and it's just something that will trade within that price range. And that range has two levels. The lower level we'll call the floor, and the upper level we'll call the ceiling. Very intuitive, pretty straightforward. Now, the value of a knockout will move between the floor and the ceiling right in line with the underlying market. So if you're trading gold, for example, the price of gold will trade between those two levels. If you're trading the S&P 500, it'll trade between those two levels. So what you're looking at is the price of the underlying market. It's what we call a Delta 1 product. You are trading the price of the product. It is what you're generally used to. If you, for instance, trade stocks, you buy a stock, you sell a stock, you're trading the price of the stock. When we're trading this, we're trading the price of crude oil, gold, an index, a foreign exchange pair. And that price will trade between the floor and the ceiling. And it's pretty straightforward. If you think the market's going to go up, you would buy the knockout. And if you think it's going down, you can sell it. And that sometimes is a little confusing to people in that they go, how can I sell something that I don't own? You are simply taking a short position. You're trading the price of the product. So if you think the price is going to be lower later, you can sell it and buy it back lower for a profit. If you think the price is going higher, you could buy it and sell it higher for a profit. Now, it could also go against you. So if you sold it and it went higher, you would experience losses, just like if you bought it and it went lower, you would experience losses. So the price is going to move between the floor and the ceiling on a knockout, and the contract will end in one of two ways. And we're going to get a little further, like what happens if one of these doesn't occur, but we'll talk about that in a second. First, it can settle by price. I'm sorry, I had a lapse there. It can settle by price. And what that means is we've got a floor and a ceiling on this contract. If the price of the underlying touches either the floor or the ceiling, you would get knocked out of the contract. We would settle the contract at that price. All right, so that's one way it would end. And if you had bought it and it touches the ceiling, you would experience maximum profit. If you bought it and it touched the floor, you would experience maximum potential loss. And the vice versa is true. And I'm going to go through examples to make that clear. But one way that this contract would expire is it touches one of the prices, the floor or the ceiling, and that's why it's called a knockout. If it touches one of the price levels of the range, you get knocked out of the trade, either experiencing maximum potential profit or experiencing maximum potential loss. The other way that it would settle is time. All right, and here you buy or sell a contract. All right, you buy or sell the price of something, you buy or sell the price of gold, and it never touches the floor or the ceiling by the expiration time. There is a settlement. These are weekly contracts. And if at the end of the week it hasn't touched either the floor or the ceiling, we will settle it at a final price at expiration. And your potential profit or loss would be the difference between where you bought or sold it and where it settled. And again, I will go through examples and show you. It makes a lot more sense when you see it, but I do like to explain this up front. Now let's talk a little bit about binary options before we go over to the platform, because binary options are different, right? They aren't a Delta One product. And when you're looking at a binary option, you aren't, while you're trading what's going to happen with the price of an underlying, you're not trading the actual underlying price. So what is a binary option? It's a short-term defined risk-reward contract, and it's a prediction. That is what it is. It is a prediction, and that prediction has three components to it. There's the underlying market. Again, I'll just use one as example, gold. It has a condition, which is also sometimes referred to as the strike price or the level, and it has an expiration time. Now, that condition is a set price. So will gold be above $1,600 an ounce in a certain time? And there are different time frames. You've got plenty of choices. I know, and we're going to go through that as well. And so it's a simple prediction question. Will the Dow Jones close higher than this price in this period of time? That's an idea that you probably are familiar with in other contexts as well. I don't want to equate it to gambling, but will the Chicago Bears cover the spread against the Vikings? Yes or no? Okay, so a binary contract, it's a underlying market, it's a condition with a time, and it doesn't matter whether you're buying or selling. You know, getting into it, what you could potentially make and what you could potentially lose. Now, the difference on a binary option is it will trade between 0 and 100. Those are the floors and the ceiling for the price of a binary option. This is the price of a binary option. It will trade between 0 and 100. And what is that number? What does that 0 or 100 represent? And as I mentioned, these are predictions, and it's either a true or false, or a yes or a no. That's why it's called binary. It's one or the other in the end. And if the statement is true, the contract will settle at 100, and it actually represents $100. And if the statement is false, it goes to 0. All right, so that's it. It's two choices in the end. In the end, binary options are all or nothing. It's either yes and it goes to 100, no, it goes to 0. And what you could think of is the price that the binary option is trading at. You can think of it generally as reflecting the probability of the event occurring. So the market is going to price the probability. If gold is exactly at 1600 and the question is, will gold finish above 1600? It's probably a 50-50 chance, because gold could go up or gold could go down. The market is going to price the probability of that right around 50. If there's a higher probability, so if gold were trading at 1700 and the question is, will it close above 1600, that probability is going to be much higher than 50%, because it's already significantly higher than the prediction level. And if it's lower, if gold were at 1500 and the question is, would it settle above 1600, because gold's lower, the probability on that being true is going to be lower than 50%. So we will go through these examples. And what's even more interesting is the impact of time on these, because we've got 5-minute binary options, we've got 20-minute binary options, we've got hourly, we've got daily, we've got weekly. And when you take a look at the impact of time on a binary option, it really does, or it can change the price of that option dramatically, and we will go through an example. And as I mentioned, time, just like other, you might have heard about other types of options like calls or puts. Like those, time definitely is a factor, as is volatility. If something is very volatile, it'll draw the probabilities of different strike prices towards 50, because no one really knows what's going to happen. And if volatility is low, you'll see greater differentiation between the prices of those options. So those are my basic definitions. Now, before I go any further, this is really important, because we talked about how a knockout, it either touches one of the boundaries and you get knocked out, or a binary option, which is all or nothing, it goes to 0 or 100. Now that's if something, if it hits a knockout level, or when it expires a binary option. It is very important when trading any of these options, just like trading any other product. Just because there's an expiration associated with the contract does not mean you have to wait until expiration to see what happens. You can always choose to exit the position early. In fact, most people generally do. They'll get out of it early. They'll do that to either lock in profits or limit losses. So you do not have to experience maximum potential loss, and you don't have to wait for maximum potential profit. You can always change your mind, change your opinion, and exit your trade and move on to the next trade. So this is not just to set it and walk away, although you can. There are people with strategies where they set it, forget it, and wait and see what happens. But if you want to exit a position early, you absolutely can. And that is something that differentiates Nadex from, for instance, other binary options exchanges, is we've got a variety of expirations, a variety of products, a variety of levels that you can choose from, and you can buy and you can sell, and you can always liquidate a position early. So really important that you can do that. I will emphasize that as we go throughout the rest of the presentation. And before I jump over to the platform, I do like to put this up. As I mentioned, this is an interactive session, and I don't know if anyone's typed any questions into Sophie, uh, because I haven't looked, but I hope you're keeping her on her toes. If I didn't make sense on any of that, or if you've got any questions, or you just want to give a shout out to Sophie for saying thank you for being there for any questions, you can certainly do that. But if you wanted to contact us, you can always email us at customerservice@nadex.com. We are also all over social media. I suggest you follow us. I really suggest you follow us on YouTube because we post a lot of content to YouTube, a lot of videos. This session is being recorded. So if you wanted to come back and play this again at your convenience, it will be posted in our YouTube channel. It will also be available on our website, which is important because a lot of people like to consume content in their own time frame, or they like to review it again at a different pace. And we certainly make that available to you. And if you even wanted to go binge watch Nadex educational content, you could certainly do that as well. The one last thing I'd like to mention, if you notice this trustpilot.com, we would love if you left us some feedback. All right, we do put ourselves out there on Trustpilot. If you're not familiar, it's a review site. It's a review site, and we would love if you posted something. Just you go to trustpilot.com/review/nadex.com and tell us what you think, and share any insights or ideas. It's out in the public domain, so I do like to mention that as well. All right, I am now going to jump over to our website and our platform. Give me 1 second. And I think this is what I want. Yeah. All right, you should now be looking at our website. And excuse me, I'm going to take a sip of coffee as though I haven't had enough already. And there is a couple things before we jump into the platform. As I mentioned, we are available to you, just as Sophie's in the background to answer questions. If you notice, you can chat with an expert. We do have a chat function on our site. We also have our contact page on how you can contact us. But the other thing I wanted to mention is we do have a learning center where we put up different blogs and some fantastic content that you can read through in your leisure. We also have other learning content that's out here, articles, mostly educational in nature, platform tutorials. Some of the things that I'm going to show you today, we offer up in bite-sized 2-3 minute pieces, even some fun things around 5-minute binaries, and trading some of our products. I'll let you explore that, but I do want to mention in our webinars section, all of our upcoming webinars, you can register for any of them from our website. I am going to point out that we are going to be doing a 3-part series starting on October 1st, and we're going to do a deep dive into each one of our products. We're going to start with call spreads. We'll then jump into, as the second part, a week later, will be knockouts, and then I'm going to be playing wrap up with a deep dive all into binary options. My colleague Adam McCaden's going to be doing the first two. He's our product specialist. So again, great resource. You don't have to wait for an email to sign up for any of our webinars. You can come and see what's coming up. We also put everything in the archive so that you can locate something that we've done in the past and you can watch it. But again, we also have a lot more than just this on our YouTube channel. All right, I am going to go ahead and log into the platform. And you'll notice when I log in the upper right-hand corner, it does say demo. Now, if you don't have a demo account, I encourage you to sign up for one. It's a great way to play with the platform and learn the products and even do some practice trading, right? So you can become comfortable and confident. In a demo environment, we do stream real prices. So the prices we're going to be seeing in our demo environment are coming from the live environment. However, your experience in demo will be distinctly different than live. People who are in demo are just practicing and playing, and so you're not going to get the real interaction of the market. People in live, you've got a whole world of participants who are looking to trade these products. So if you put an offer or a bid between the bid-ask spread, something may happen in live environment that may not happen in demo. So I don't want you to think that it's the same experience, but it is the same prices. Okay, and we do offer this, and the reason I'm going to use demo is because I'm going to be putting in some demo trades, and again, no buy or sell recommendations. I just want to show you, how it works. If you haven't been to our platform before, you'll notice on the left-hand side, we've got our products. We're going to have our workspace in the center, which is where we'll be spending most of our time, and there's this positions tab below. Up on the product side, there are binary options, there are call spreads, and I'll mention those as well. And then there are knockouts. Let's start with knockouts because I think they're the most intuitive. This is your Delta One product. You're trading the price of the underlying. So let's take a look. And by the way, you'll notice we've got them in indices, all right, knockouts. And if you're not familiar with these names, these all settle to the futures contract. The US 500 is the S&P 500 futures contract. It'll settle to that price. The small cap 2000 is the Russell 2000. Oh, why do I have that in there twice? This is what happens when I'm in demo. Our NASDAQ one is missing. This is this is what happens when I'm in demo. And then the Wall Street Journey is the Dow Jones Industrial Average. In foreign exchange, we do have, and we've just recently added a bunch of different pairs in knockouts, something that people have been asking for quite some time. And then we do have commodities. We initially started commodities with crude oil and natural gas. Crude oil and gold. We've recently added natural gas and silver. So, since I've been talking about gold, I might as well, and I'm here. Let's just go ahead and start here. If anyone would like me to play around with a different product, by all means, type it into the chat and I'll bring that product up. But again, I'm not no buy or sell recommendations. I simply want to show you what knockouts are and how some of the tools that are available can help you in making your trading decisions. When I come to gold on the knockouts, I'm just going to go ahead and click on any one of the levels. Right? And I'll explain why it doesn't matter in a second. I'm now going to hide that. And I'm also going to hide the positions pane because I want to see more of our charts. All right. And hopefully that all shows up really well for you. Notice I currently have a knockout because it's the one that I clicked on for gold. It's the 1857 to 1907. We're giving you the floor and we're giving you the ceiling. Notice that on the chart, 1857, the floor is clearly marked, and the ceiling, 1907, is clearly marked. All right, so you can see what the floor and ceiling. If I wanted to choose a different knockout range, this is why I said it didn't really particularly matter which one I clicked on initially, is you'll notice on the left-hand side of the chart, there are 4 blue lines, and I can quickly switch to a different one by simply clicking on it. So if I wanted to, this is one where the price is right now in the middle of the range. Now, I don't know what gold is going to do. Let's just assume for a second that I thought gold were going to go lower. Okay, so I might want to trade this knockout. Again, I'm just making an assumption, and I'm just saying that because it looks like. Let's just take a look. Let's put a 1-week chart. Let's put it for 10 minutes, and I'm gonna even do a little scrolling. It looks like gold has been in a downtrend. Okay, so again, I'm not no buy or sell recommendation, and let's just say I think I was going to go lower. Again, let's pick this knockout because I thought it was going lower. And the reason I'm picking this one is, again, my assumption. I think gold's going lower, so I want to sell it. Okay. Now, if I sold one here, what is this? 1873. So let's just click on 1873. It's a nice round price. And I'm going to go ahead and place my order. Okay. Again, not a buy or sell recommendation. You'll notice that I got my order received, and you'll notice because I was just trying to sell the bid, I actually did sell one in the demo environment. In fact, I got 1873.10. Okay, great. Okay, so again, not a buy or sell recommendation. I just wanted to, I just made an assumption out of thin air. Now, selling one of these at 1873, what did I do? Well, I know getting into the trade where my ceiling is, and I know where my floor is. Okay. If I were wrong and gold were to go up and touch 1887, which it clearly did yesterday, it was up in that range. If it touched 1887, I would get knocked out of this trade. I would get knocked out and I would experience my maximum potential loss of $140. I knew when I sold this, it actually told me this is the most you can lose. I can't lose any more than that. Now, if I sell it and gold continues to go down, all right, in this little trend that it's in, and it hits 1837, that's when I would get knocked out for maximum profit. And so, and my maximum profit is 360. Now, if it were to go below 1837, if it were to go down to 1830, if it were to go down to 1800, I still can't make any more than the $360 on this particular trade. On this trade, it is defined risk, defined reward. I know getting into it exactly what I stand to potentially make and what I stand to potentially lose. Now, what happens? This contract expires in one day. All right, it's a weekly contract. What happens if in the next day gold doesn't touch either one of these levels? Well, then I will experience either partial profit or partial loss. If, since I sold it at 1873, if it settles above 1873 and never touches 1887, I will have some partial loss if it settles in this range. And if it touches 1887, remember, I'll get knocked out, I'll lose $140, and it doesn't matter. If it goes all the way back up to 1920, I can't lose any more than 140. This is where I would be stopped out for maximum loss. Now, if it were to go down, all right, I was right, and it went lower, I would experience partial profits all in this range. I would experience partial profit all the way down till 1837, at which point I would get knocked out for maximum potential loss of 360. I can't make any more than that. So I know getting into the trade how much I could stand to make, how much I could stand to lose, or if it doesn't touch either one of these boundaries, I would have a partial loss or a partial gain somewhere in there. Okay, hopefully that made sense, and that you got the idea of how a knockout works. And this is true across all of our contracts. You're going to have a floor, you're going to have a ceiling, you have defined risk, defined reward. And if you want to get out of this trade, okay, and right now, let's just say, you know what? I'm looking at the long-term trend and it's been going down, but it's definitely the short-term trend here. It's going up. All right. We could see gold's rallying, and I changed my mind. I do not have to go and lose all $140. If I just want to buy it back and say, whoops, I made a mistake, I'll buy it back for 1874. Okay, maybe I just want to lose $10. I made a mistake. I can place that order to buy. All right, my order goes in. There it received my order. You can actually see my one lot right there. This is a demo environment. And then the market's gone a little higher. So here I just said, whoops, I sold one at 1873. I didn't want to lose that. Actually, I'll take it off for a $9 loss. I put an order in to buy it back at 74, and look, it keeps going higher. I don't know where gold's going, but the point being is you can exit a trade early. And if this this initially had actually gone down. If this had gone down to 1860, I could have put, I put in an order yeah, I could have bought it back lower for a partial profit. Very clean, very simple. Hopefully, if you have any questions, you're typing those into Sophie in the background. Those are knockouts. Now let's jump over to binary options. A little different. Binary options, I'm going to click on binary options. And remember, these are different, okay? These are all or nothing, 0 or 100, and you're trading the probability. If you take a look on the indices, we've got global indices in binary options. The FTSE, the DAX, if you wanted to trade Germany. All right, you can see here the NASDAQ. Now, let's just take a look just for fun for a second. In the NASDAQ, notice how we've got a contract that expires. Actually, this one might have expired. That one expired already. This one expires in 58 minutes. We've got one, it's a daily contract that expires in 3 hours, and there's a weekly contract that expires tomorrow. All right, so we do have a variety of choices. We also have these in the commodities. Okay, probably more popular. People like to trade our foreign exchange. I mean, you can see how, I mean, we've got a bunch of different settlement times, expiration times for you to make your prediction in, and very popular contracts. We do have these 20 minutes. All these 20 minutes are indices, but we also have these 5-minute binary options, and these are foreign exchange. And I am going to do the 5-minute ones. The reason I like to show the 5-minute ones is, let's just start for a second. I just want to give you an example of a commodity. Let's choose weekly. Let's just go to gold weekly for 1 second. And you'll notice that there are all these prices. And I am going to go back to the 5-minute binaries in Forex in a second. But you'll see on your chart, it gives me all of the different yes or no statements for gold. Now, this doesn't settle for a day, but you can see as gold moves, these probabilities don't move. These prices aren't changing too much. They're changing a little bit. This is the midpoint around 28. They're saying there's a 28% chance that gold will settle above 1880. Notice if I'm going to buy it, it turns my chart blue where I need it to settle for this to be a profitable trade. If I didn't think it was going to get above 1880, I thought it might rally but not get that high, I could always sell this. All right. And if I sold it at 28 instead of buying it, I could potentially make $28. It needs to stay in this red zone. But if it goes and it does settle above, it goes to 100 and I would lose 72. So all of these are the probabilities. And notice there's a day to go here. They're not changing dramatically. But it does tell you on the chart if I were to sell it where I would need it to be profitable, or if I bought it where I would need it to be if it were profitable. And it always tells you your maximum profit, maximum loss up front. And I'm doing this on 1 lots. Now let's go back to these foreign exchange 5-minute binaries. And actually, I can see that this set of binaries is going to settle in exactly 30 seconds. And so what I want to do actually is I want to start with one of these at the 5-minute mark. And the reason I want to do this is you will see how the probabilities of these change very rapidly. And this will be true of all of our binary options. Even though gold right now is ticking very slowly, as this gets close to expiration with only minutes to go, you will see the prices of these change pretty dramatically because it either goes to 0 or 100. That is it. 0 or 100. It's an all or nothing game. So let's take a look at the Euro US dollar. Okay. And I'm just going to pick this one level. Let's make this chart a little bit bigger so we can see all the strike prices. Let's get rid of this. Let's just make this a 1-day chart. Let's make this a 1-minute chart. I think that's going to be a little bit more useful because we're trading 5 minutes. All right. Notice the probabilities on these. The first one that I had actually picked was around 50% probability. It is now trading around 63%. All right. That's because the price is currently above. Okay, there, I actually want to make this a little easier to see. The price is currently, you can see that it's trading at 116.66. Now look, as this starts ticking down, look at how the price of this starts ticking back toward 50%. All right. If it were to start ticking higher again, and there it is, it's ticking higher again. I am watching the underlying move, and I'm watching the probabilities change pretty dramatically. This contract only goes for another 3 minutes and 30 seconds. Now, let's say, for example, I think it's going to go higher, but it's not going to get above 1665. Although it was just here, who knows? I could choose to sell this one in the 32 range. And if I place my order, you would see my order show up, and I am risking, and I sold it. I risked 32. Now look, as it ticks higher, all right, as it ticks higher, this starts ticking higher pretty quickly. I could only make $32 because if it goes to zero, if it settles above, so it would actually be in the blue range, I would lose 68. I'm risking 32 to potentially make 68. Now, when I say a lot of people will take these off early, notice how this is changing pretty dramatically. We still have 2 minutes and 40 seconds. Remember this one, which was around 50%? It's now up towards 80%. As it ticks closer and closer to this price level, my short doesn't look so good. I could say, and now I got to make that decision. Maybe I'm not happy. Maybe I don't like it. I could always buy it back for a partial loss. I don't have to lose all $68. Right? I could always just buy it back and say I've had enough. Now it's coming down a little bit. Maybe I'm getting a little anxious. I don't know what's going to happen. Maybe I want to buy it back and I'd make $10 on it. I'd buy it back if it got to 22. Okay, I'm going to place my order in there. And if this ticks lower, I'll just go ahead and make my quick $10 and I'll be happy. And it looks like I did. Okay, I bought it back. I'm done. Now, why did I do that? There's still 1 minute 47 seconds to go, and I don't know where this is going to go. For all I know, this could go back to 100. In fact, if I thought the euro were going to go high, I could just go long it now. I initially sold it. I could buy it back. But in the end, every one of these is going to settle at either 0 or 100. It is an all or nothing, yes or no. That is why they're called binary options. Okay. And so if there's any questions here, and I do like to show that, these are very dynamic. There's 1 minute and 8 seconds to go. And you know what? Now I want to sell it again. I don't think it's going to get up here. I'll sell it back I'll sell it again. I just sold it a second time. And maybe I'm wrong. All right. As it ticks higher, it looks like it's trading right here. It went to 50-50. Oh, wow. It's going right through my level. I was wrong. All right. But I still have 44 seconds. I don't know what's going to happen here. If I don't want to just take my maximum loss, I could just buy it back. I tried to buy it back for 74 and a quarter. I did. I just bought it back and I took a partial loss. And look at that. Maybe I didn't need to. The whole point of this, and I do want to point this out. Notice when there's about 20, 25 seconds to go, and this is important, everything sort of went blank. And that is because no one knows what's going to happen in these next few seconds. And we are going to watch. I just want to see in the next 11 seconds, this is sitting right here at this it's exactly at this level. Is that crazy? Right exactly here. And it looks like it settled just below that contract. I think actually settled at 0. And this one went to 100, and this one I think went to 0. It's incredible how quickly these can change. And now notice we're on the very next 5-minute cycle. And now all these prices and these probabilities, again, remember you're trading the probability that this question is going to be true or false, and you buy or sell. If I think no, I sell. If I think yes, I buy. I can always unwind my position, but you see how these probabilities can change pretty quickly. I mean, this 1663 level was the 50-50 probability when we first started. and it went to 100, and all of a sudden now it's the 1667 that's the 50 level. So hopefully you understood that. If you didn't, hopefully you typed in questions to Sophie in the background to understand binary options. And when we do look at binary options, you do have these choices: 5 minutes, 20 minutes, hourly, daily, weekly, across all of our products. Now, the one last thing I want to show you, and here I just want to show you some tools that we've got available. Let's go ahead and take a look at the S&P 500, because I like to do something in the equities markets because they've been so busy. And I am going to go ahead and choose a 1-week contract, and let's make it every 10 minutes. And let's just take a look at what's going on in the S&P 500. And we've got this; these are knockouts. Okay, you can see the 4 different knockout levels. We do have tools that are available to you to help you do analysis, right? So that you can do your own analysis to help you make your own trading decisions. We do have indicators. When I bring up indicators, we have a variety of indicators. If anyone wanted to see me populated with one, go ahead and throw it into the chat. I'd be more than happy to bring up a particular indicator if someone wanted to see one. But for instance, if you happen to like Bollinger, here, actually, let's go ahead and take a look, because I did see someone put something in. Yeah, all right, Bollinger was a great one. And I'll even throw in MACD, some of the more popular ones. Let's take a look at Bollinger Bands. If you didn't know what they were, notice if I hover over the eye, we will give you some basic education. And you can learn a little bit about Bollinger Bands, that it looks at moving averages, and it's going to give you bands for moving average range above and below. When I click on that, notice it populated my chart with my Bollinger Bands and put them right on the chart. And if you look in the lower left-hand corner, if you wanted to change the standard periods, which the standard is 20 and 12, maybe you like doing 12 bar periods with 2 standard deviate instead of 20. And notice how it changes the parameters on my bands. You can set that up any way you want. Maybe you like a little bit longer periods. So we'll put in 30 bar periods, again, 2 standard deviations, and you'll get your some ideas on what Bollinger says would be potential resistance levels or support levels. Okay, and that can help you potentially make your trading decisions. Oh, you know what I wanted to do is we were on the S&P 500. Yeah, bring those back up. Let's click on one of these. Okay, good. So that's Bollinger Bands. I also wanted to show, because someone had asked, we could put on moving average convergence divergence. Notice that every time I do that, I clicked away from the product, and I want to keep the product up there. There we go. It gives me my my MACD indicators below, when I can look for things that might be overbought or oversold. Again, if you didn't know what MACD, there we go, what these represented, all right, they're trend indicators, and there's a signal line, and when it crosses, when the moving averages cross through the signal line, it kind of gives you some ideas on when you might see some pivots in the market. Again, I'm not making any buy or sell recommendations. I'm simply showing how to use the tools. The other thing that I wanted to show you, one other fun tool, is we've got a variety of drawing tools. And when I say drawing tools, you'll see that you can put in your own trend lines. You can put in your own channels. And I'm just for fun, let's just kind of show you. And this is actually kind of important. If you were to look at the trend over the week on a channel, and I'm just kind of fitting one in here, we might have seen, this as a bit of a downward channel. This is a longer term time frame, and you're looking, hey, we're in a downward channel. But then again, at the same token, if I'm looking very short term, it looks like we're having a bit of an upward channel. So it does matter what time period you're looking at when you do use technical indicators. Are you looking at a little longer? Are you looking at a little shorter? You will see variations in trends. One of the things that I find can be very useful when people are looking at that is actually the Fibonacci retracement levels. If you're not familiar with Fibonacci, a lot of people use this as a tool. Um, Again, it gives you some retracement levels. If you're not familiar with Fibonacci, it's a ratio that's seen in nature and in science and in the human body. Humans have represented this perfect ratio in architecture. But if you wanted to see, and you don't have to know how to calculate it, we'll calculate it for you. I'm going to go ahead and click. We have been in a bit of a downtrend, so I'm going to just sort of fit this to a downtrend. And again, we've got an awful lot on this chart, but when I do put this in, there we go. There we go. All right, I put my Fibonacci, and it's going to give me my retracement levels. You could see on the way down, it did give me some places where you saw potential support, um, uh, on its way down, but then it kept going lower. And then interesting on the way back up, where it started giving some potential resistance. Then it traded in this actual channel, this channel of Fibonacci for quite a while. It broke back down, and then on the way back up, you saw some rough resistance levels. And again, where it got support, it went through resistance levels, support, and now that it's going back through, we got a nice up channel here, and with Fibonacci, it looks like we might see this rally back up, into the 3270 range before it sees some resistance. Again, not a buy or sell recommendation, just looking at Fibonacci. But what that can help you do is you can also be looking, oh, well, if I thought that were the case, I could use one of my knockouts. Oh, no, I want to use the higher knockout. Hey, if I thought this was going to continue to go higher for a little bit, all right, here's a knockout where, all right, if I were to buy in this 32.59 range, now, if it were to come down and touch 32.42, that's where I would get, and let's go ahead and zoom in a little bit more so you can get a better sense of what we're looking at here. I know if I were to buy here, I know if it went down to this 32.42 level, which was roughly a level on Fibonacci, this is where I would get knocked out for a loss. But if I thought it was going to rally and had an opportunity to maybe make it up a little further, I could either look for it to go all the way back up to 32.92, which it hasn't been there in a while, or I could take a partial profit. Okay, that was an overview of knockouts and binary options, the different variety. Now, I did want to mention briefly call spreads. Call spreads similar to knockouts. All right, call spreads similar to knockouts, with the difference that it is going to give you a range. What I want to do here is I'm clicked on this and I want to get rid of all of my drawings. I'm going to uncheck them, the indicators, and I'm going to delete all drawings, just so you can see what a call spread is. And the way a call spread works, it's got a range as well. Okay, I clicked on this call spread. Let's do that. I clicked on this call spread. It's got a floor and a ceiling. Okay, the difference here is if it touches one of the boundaries, you are not knocked out of the trade. Right? Your maximum potential profit or maximum potential loss getting in. It's just that if it happens to go against you, you're not knocked out for a loss. But if it goes in your favor, you're not knocked out for a profit either. The only way to get out of this is to trade out of it or wait until expiration. And because it has that optionality, all right, because there is this range where it can trade, notice that it isn't going to trade as a Delta One product. You can see where the indicative price is and where the price of the contract is. They're different. So it's a little bit more confusing because there's a premium baked into the price of the product that you got to factor in. Whereas a knockout, it is what you see is what you get. And that is the difference between knockouts and call spreads. Similar in nature, but call spreads give you more time to be right, but there's a premium involved. Knockouts, no premium, delta one, you get knocked out. And lastly, binary options, all or nothing, 0 or 100, and it's the probability that the statement will be true. All right, so if you buy it and it's true, it goes to 100. If you buy it and it is false, it goes to 0. And conversely, if you sell it and it's true, you would lose. But if you sold it and it's false, you would win. With that, I want to thank you all for joining me. I also want to encourage you, please sign up for future webinars. Take a look at the webinar section. That Trustpilot link, we would love if you gave us some feedback. In fact, let me put that back up very quickly. We'd appreciate it if you gave us some feedback. Take a look at that Trustpilot link, trustpilot.com/review/nadex.com. Thank you again for joining me today, and I want to wish everyone good luck in the markets.